Have you ever wondered if something you committed to years ago still makes sense for your current life, especially when it involves a long-term financial product? It is a common question, and understanding your options is key to making empowered decisions about your financial future. People surrender whole life insurance policies for a variety of significant reasons, primarily when the policy no longer aligns with their evolving financial goals or needs. This often happens because circumstances change, and what was once a perfect fit might become a burden or simply less beneficial than other available options. Surrendering means formally terminating your policy before its maturity date, typically in exchange for its cash surrender value, which is essentially the cash value built up over time, minus any fees or outstanding loans. The core mechanism behind surrendering a whole life policy revolves around its cash value component. Unlike term life insurance, whole life policies build a cash value that grows on a tax-deferred basis over the life of the policy. This cash value acts like a savings account within the policy, accumulating over time as you pay your premiums. When a policyholder decides to surrender, they are accessing this accumulated cash value. However, the surrender value received is often less than the total cash value, especially in the early years, due to surrender charges that insurers levy to recover their initial costs. Deciding whether to surrender involves carefully weighing several factors. First, consider your current need for the life insurance coverage itself. If your dependents are grown and financially independent, or if you have accumulated substantial assets, the original need for a death benefit might have diminished. Second, evaluate the financial performance of the policy versus alternative investments. Sometimes, the returns on the policy's cash value might be lower than what you could achieve elsewhere. Finally, assess the ongoing premium payments. If they have become a financial strain, or if there is a more efficient way to achieve your financial objectives, surrendering might be an option. It is important to remember that the cash surrender value is not the same as the total premiums paid. Insurers typically have high initial expenses, and these are often recouped through surrender charges, especially if the policy is terminated within the first 10 to 15 years. You might also encounter tax implications, as any amount received above the total premiums paid into the policy can be considered taxable income. This is why financial professionals often recommend exploring other options, such as a policy loan, reducing the death benefit, or even exchanging the policy for an annuity before a full surrender. Ultimately, the decision to surrender a whole life policy is a deeply personal financial choice driven by a change in life circumstances, financial priorities, or the desire for more liquidity and control over your assets. Understanding the mechanics of cash value, surrender charges, and potential tax implications empowers you to make an informed decision that best supports your personal financial journey and long-term security.